In today's video, we're going to talk about corporations in Canada, one of my favorite topics. And by the end of the video, we're going to understand the difference between active income, passive income, and some of the different mechanisms on how your corporation or small business is actually being taxed in Canada. So let's get into the video. Now, if you have an idea for a video, please comment below what you'd like to see next. Please like and subscribe. It helps the channel grow. I really appreciate all the support. But without further ado, let's get started on corporations and taxes within Canada. So first of all, what is corporate tax? Well, corporate tax is the net income within a business or what we call fiscal year. So this could be June to June. It's whatever the business has set up. Within that year, that business year, how much net income is actually earned and how that is being treated when it comes to taxes. So every business is going to have what we call revenue. That's money coming in. It could be through sales. It could be even through commissions, depending on the type of business or small business you have set up. And then whatever is coming out of the corporation within that year. So that's expenses. That includes also salaries that you not only pay yourself, but maybe you have an assistant on payroll. You have other employees depending on the size of your business. And of course, you have other business costs that are related to that. So those are generally your deductions or your expenses, and then what's remaining and what's left over is what we would call in simple terms our profit. So profit is basically what we call net income within a corporation within a year. Now that money is actually what we call active income. So active income is income that's earned from the revenue generating activities of a business. So for example, if you are a real estate development company and you build a condo building, the profit that was made on that project is of course active income within the business. If you're a, let's say, real estate agent, the commissions that you make from selling properties is your active income that was made in the pursuit of actually doing your job or doing your business. Passive income is a little bit different though. Passive income we're going to talk about later in the video, but basically what that is, it's any income that you earned off investments. It could also be income that's earned off of real estate rental if the business isn't primarily a real estate company or a company that works in real estate. And you have, let's say, investment properties owned by the corporation, but you're getting paid rent. That's actually considered passive income. Also, capital gains on other assets, that could also be considered as passive income as well. So we'll get into passive income a little bit later in the video, but let's focus in on active income firstly, and then we'll move on from there. So now we understand what active income is. Let's talk about the different levels of active income depending on how much is made in a year and what that rate is going to be. So there's actually only two rates for active income, what we call the small business tax deduction. So anything up to the first $500,000 in certain provinces, it could be like Saskatchewan up to $600,000. But for the sake of the video, let's just say for most provinces across Canada, it's $500,000 of net profit in a year that's earned in the business. That first $500,000 is actually taxed under what was called the small business tax deduction. So in BC, that happens to end up being a total of 11%. So that 11% is divided into two parts. The federal part is actually 9% and the provincial part is actually 2%. So it's 11% total, but it's actually split into 9 and 2%. Now, above the $500,000, so let's say as an example, the business earns $1 million of net profit. The first $500,000 is still going to be taxed at that small business tax deduction of 11% in BC. So above the first $500,000, it goes into what we call the general tax rate for corporations. So the federal level, it's taxed at 15%, and on the provincial level and in this province, it's taxed at 12%. So the total ends up being 27%. So to summarize, we have two tax levels. Of course, the first $500,000 under the small business tax deduction, that chunk's going to be taxed at 11% in BC. The remaining money above the $500,000 gets taxed at the general rate, which ends up being 27% when you combine the federal and provincial rates. So for people that have a corporation that are unsure whether they should just pay out a higher salary so that they stay below that $500,000 small business tax deduction, it might not actually make sense to forcibly take out more salary just to stay below that. Now, if you do make above $500,000 in a business year, you're doing pretty good. Your business is profitable. So this is a good problem to have, right? After all the salaries and everything expenses is being paid, that's a good amount of income to be making. So of course the question is, how much do I pay myself in dividends? Now, this is a question you have to ask your accountant and really do the math, crunch the numbers and figure it out. But in general, a lot of people ask me, do we want to pay out a larger dividend if I'm above that 500,000 because now, I'm at a higher dividend rate or I'm at a higher tax rate. But the reality is because you're at a higher tax rate, you get a larger dividend credit on the money earned above the first $500,000. So any income in a corporation that's earned above $500,000, it falls into what's called an eligible dividend, whereas the first $500,000 is actually called an ineligible dividend. All that means is that by the time you actually end up getting your tax credit on your dividend, on the first $500,000, you get a smaller tax credit simply because you're paying less tax initially. And on the money earned above $500,000, you're going to get a larger tax credit because of course you're paying more tax initially. So you're getting basically the same in both cases. So the reason that Canadian government does this is just to make it more fair so that you're not getting double taxed. You're not getting taxed more in one scenario or another. Now for today's video, I don't want to get too much into dividends because it gets really complicated, and I can actually make another video if you guys want to know more about dividends taxes in Canada and break down all the details and the mechanisms. But for today's video, we're just going to keep it really simple and we're just going to talk about the main points. So we now understand active income and how there's two separate brackets and how exactly it's taxed. What about any income earned from investments? So for example, if you have a business and you want to buy stocks, you want to buy a mutual fund, you want to buy a GIC, for example, you want to invest in a REIT, or you want to invest in even a private equity deal, or you want to invest in real estate, you buy a property or commercial property and you have rent coming in and those checks are hitting your bank account. What now is the taxation on that money that you're earning? So it really depends because this all falls into what's called passive income. Passive income in a corporation is any investment income or money that's not a direct result of your business and what its primary purpose is. So for example, you own a car wash, but the money that's being made on your stock portfolio isn't actually part of the business. So that money that you're earning, if it's dividends coming in or you're selling and earning a capital gain, or there's interest from say a GIC or a term deposit, that money is actually income that's earned, or it's actually dividends or capital gains, and that is actually subjected to the passive income tax rate, which is much different than the active income tax rate. So it does get a little bit complicated, but in general, to summarize, passive income is any income earned on an investment. So for passive income in a Canadian corporation, the federal rate is 38.7%, and it does vary again, province to province. I have the link in the description. You can see exactly what that's going to look like in your province. But the BC rate is 12%. So in total, in BC, you pay 50.7% tax on your passive income. Now that might sound crazy and you might think, why would I pay way more on my passive income? That's like, a significant increase in how much tax I'm paying. Of course, even if I'm making over $500,000, I'm only paying about 27%, 51% nearly, that's double the amount of tax. Why is it set up so unfairly? So the reason that the Canadian government does this is because they want to have a fair system. Now, it might not sound fair, but in the end of the day, there are higher tax credits. And like I said, with dividends taxes, eventually we actually build up a reserve in a special type of nominal account within our corporation when we actually are earning passive income. And I don't want to get into too much details on that, but we'll talk a little bit about that as we go forward. But before we do, we want to understand that in a passive income scenario, there's three different types of taxes that we can earn depending on the type of investment. So either we earn what's called interest. That would be, for example, GICs, term deposits, or anything that just pays us a set rate or a fixed rate, 100% taxable at that passive income tax rate. So we end up paying exactly 50 to 51% on our interest. For example, you earn a GIC, you have 5%, you're only going to keep about 2.5% of that, but a little bit of that passive income does credit us on something that actually gives us a refund later on in the corporation, which we'll talk about next. So in general, you're getting taxed 50% on any interest in your corporation that's passively earned. Now, capital gains are taxed differently. So capital gains until January 1st of 2026, they put a pause on the increase in the what we call exclusion rate on the capital gains, increasing to 66.7%. So that 50% rate still is maintained until next year, but on a capital gain, it's half taxable. So if you made $10,000 capital gains this year, you basically would take half of that, $5,000, and you would get taxed on that at the passive rate, which is 50%. So all in all, you end up paying 25% tax on the actual capital gain because it's 50% of about 50%. So that's capital gains and how much you're getting taxed in your corporation. And it's still very high compared to owning a property personally and getting a capital gain. And then of course you just, pay half of that on your actual marginal tax rate at your personal income, which could be, 30 or 20% instead of 50%. So you're still getting gouged pretty hard within that corporation. Now, one nice benefit with capital gains in a corporation is that the half of it that doesn't get taxed, so let's say that's $10,000 capital gains, that first $5,000, it's tax-free, but not only is it tax-free, it goes into a special account called the capital dividend account, which is just basically a nominal account that's earmarked to the CRA to allow the shareholder to take that money out tax-free at any time later on. So any money within that, it's like a credit that allows money to flow out of that corporation tax-free. So not only is it tax-free, it can flow right out of the corporation to your personal hands tax-free, and that's on that 50% portion. However, on the other 50% portion of the capital gain, that's the piece that's actually going to be in the corporation getting taxed, and that's where it's actually going to stay. Now, dividends actually have a slightly lower tax rate at about 38.33% because it came from a taxed source to begin with. So instead of paying that 50% tax rate, it's going to be at a 38.33% tax rate. So it's basically lower than your interest and slightly higher than your capital gains at the end of the day. Now you might wonder, why is the passive income tax rate so high? And the reason is because the CRA wants to make it fair. They say that they want to make it so that an employee is basically going to pay the same investment income tax as a business owner, so that business owners can't leverage the system and get ahead quicker and make it easier for them to build their wealth through investing. That's basically the whole reason why it's called integration. So it's a system that CRA created. Whether you agree with it or not, that's a debate for another video, but for today, we're going to talk about the facts. So the way that they accomplish this system of integration is with something called the RDTOH. Again, I'm not going to get into all the details. It's a little bit complicated, but for the sake of the video, let's just talk about how the RDTOH basically works. So essentially, it's a nominal account like the capital dividend account, but in this case, it creates a tax credit that will be refunded back to the corporation later, or the shareholder, which is the company. Now, the question that you all have most likely is, how do I actually take money out of my corporation the most efficient way? Do I take out more dividends? Depending on my situation, do I pay a higher salary? How do I finesse this, so to speak, so that I get the best bang for my buck? And where do I invest my money? Well, that's a question that you have to discuss with your planner, your advisor, and also your accountant, so you can really figure out the best mechanism to do that. There's a lot of factors at play. There's no one size fits all. But all in all, guys, that's exactly the content I wanted to cover in the video, is just how exactly active and passive income in a corporation works. I hope you enjoyed the content. Please leave me a thumbs up, subscribe to the channel, and I hope to see you in the next one.